It's a great time to have the portfolio managers of the Perennial Strategic Natural Resources Fund here to help us navigate the current markets. We currently have geopolitical concerns, tariff wars, money flowing out of US tech and US bonds, and yet the ratio of commodities to stocks has never looked cheaper. Despite worries of a US recession, hard assets look like a good place to invest after years of underinvestment, especially if the US dollar continues to fall. Yet across the commodity space, there's a wide divergence. Gold, silver and copper are doing well, while coal, uranium, nickel and lithium are all on their knees. So we've got Ewan Galloway over here and Sam Berich. They're our go-to resource experts, and many clients have once again asked to hear their thoughts on the current situation. So prior to joining Perennial, Ewan was an investment banker at Deutsche in London and has an MBA from Columbia University. Whilst prior to joining Perennial, Sam was a metals and mining analyst at Royal Bank of Scotland. Sam also has hands-on experience in the mining sector in open pit and exploration, and has a postgraduate honours degree in geochemistry. So please welcome them. Guys, maybe we start with a little bit about the fund, the opportunities and the threats, and your favourite commodities, and then I guess we'll leave about 10 minutes for Q&A, or do you want questions as you're going? Or?
Oh, I'm open. I mean, if there's questions along the way, then yeah, by all means, shout out. But you know, certainly plenty of time for Q&A. Thanks very much, Peter,
you guys
for the introduction. Yeah, thanks everybody for coming in. It's a decent crowd. It's I try and keep these conversations as sort of informative and perhaps a little bit edgy. As when you touch on the energy space, it's unfortunately become very political. So we'll see if we can't upset somebody by the time the presentation's over. But just a quick run through of the fund, just to begin with, and in very in short form, to explain what we're trying to do. We will start off with the performance because it is very good. Whilst it has been a difficult period for a lot of active managers over the last 12 months, and particularly the last 6 months, we have done okay. We're still sitting at a one-year number of 20%. And at the end of this month, we will tick over our 5-year anniversary, averaging 27% for our investors net of all fees. And the way that we've done that is by, primarily through commodity allocation, and it's a very dynamic process, as opposed to investing in the ASX 200 resources index, in which you have 54% iron ore. We are much more dynamic than that. We've made good money out of gold coming out of the COVID period. We've made good money out of lithium and battery metals and managed to hold on to most of it, importantly, then pivoting into uranium and gold. And this period in the middle here, where our performance was reasonably flat, each end of that flat performance period was when central banks around the world were hiking rates aggressively with the express purpose of reducing demand to fight inflation. Now we're through that period now. The central banks around the world are cutting rates. The trajectory of that is open to debate, but by and large, lower rates mean banks are trying to stimulate demand, which is good for commodity investing and particularly good for gold, which has been doing very well in the portfolio recently and particularly this month. So here you see our commodity allocation. It does move around a fair bit. We can go up to 50% cash, and you can see, even though this is a quarterly chart below, cash does spike, quite high when we are concerned about the markets, concerned about the outlook. We will move to preserve capital quite quickly because that's what we're incentivized to do. But at the moment, or just in recent times, we increased our gold allocation quite materially in midway through January, which has worked out very well. Our other big allocations are in domestic natural gas, for leverage to that our energy shortage in Victoria and New South Wales, which is coming. Bauxite's our other big exposure, along with allocations to copper and copper, uranium and rare earths we've been increasing recently as well. So what sets this commodity fund apart from the other ones, and what we try to do is be the lower beta or the less volatile means of commodity exposure. There's maybe a dozen commodity funds you could choose from, and you look at their history of returns, and there are periods of excellent performance within almost all of them. However, for the vast majority of those, tend to give most of that performance back, through not moving to preserve capital quick enough. And so the way that we try to be a little bit different and dial down that volatility whilst maintaining exposure to the upside is we do invest in physical commodities, and we do that because with a physical commodity, there's no balance sheet risk, there's no operational risk, there's no weather risk, there's no dodgy directors, there's no geopolitical risk, there's nothing. So you still get the same underlying exposure to the commodity that you want with less volatility. We also do play in the industrials space, or more specifically, the businesses that support the activity of commodity production. We get to see these guys on site when we go to mine sites, when we speak to energy companies. They're often very happy to promote the new approach they're using in their business or some part of their business. Quite often that's provided by a listed company. And we do get, I think, a bit of an advantage in understanding those businesses relative to generalist investors that don't spend as much time on mine sites as what we do. Also, their earnings streams, generally speaking, are less volatile than the commodity producers. So again, focused on reducing that volatility. And thirdly, we are a long-only fund, and we have an absolute return benchmark of 6.5% net of our management fee, or after deducting our management fee. And that can be a little bit counterintuitive, because for a cyclical sector like resources, it sort of lends itself to long short. But our analysis of the sector showed that when you introduce some degree of financial engineering, whether it's gearing the portfolio, excessive use of derivatives, or even going long short, that introduces volatility, and we want to get rid of that. So these are the 3 points of difference, and it's been working reasonably well. So if we just focus on the negative months for the 5 years that this fund has been running, so there's been 27 of them for the negative months of negative returns for the ASX 200 Resources Index. They're all plotted in grey, and our returns in each one of those negative months are in purple. So sure, we don't get a positive return in all of the negative months, but in aggregate, our return through this period was negative 15.6 compared to the index return of negative 97. So our downside capture is very, very good, and our approach in setting up this portfolio seems to be working. We're reducing that downside volatility, relative to that index, which is dominated by BHP, Rio, Fortescue, and the other major miners. So that's the fund in a nutshell. But we'll get on. That's the boring part. We'll get on to the more interesting stuff now, and what's making the world go round. The first thing I'd like to touch on is the energy transition. So this was the big selling point for lots of commodity funds and other clean energy funds around the world. And we made a lot of money out of lithium through the journey. But I think we're at 10 years in, or 10 years post the Paris Agreement now. I think we're starting to see a bit of an inflection point in the approach to the energy transition. And specifically, I think that the value of dispatchable power, i.e. the power that you can rely on and turn on at the flick of the switch, has been, the value of that has been overlooked. In the rush towards wind and solar and massive ramps up of wind and solar installations around the world, that value of dispatchable power is becoming ever more apparent, particularly in the UK. They're down to 56% dispatchable power in their energy mix. They now have the highest industrial power prices in the world, and they are rapidly following Germany into de-industrialization as their heavy industry shuts down and migrates towards areas with lower cost of power. Now, even though UK has got less dispatchable energy than Australia, they do rely on interconnectors. So they are saved by France, which has got a huge amount of nuclear, and the Scandinavian countries next door, albeit the Scandinavian countries have gotten the shits because too much power is being drawn out of their economies, forcing domestic power prices up, despite the fact they've got plentiful hydro resources, which should give them low power through the cycle. So there's certainly risks popping up here. Countries are going to be forced into producing more of their own energy, or being more energy independent. Now that brings us to our island nation here in Australia. We're at 70% dispatchable power, and power prices have been ticking up pretty steadily ever since this transition got underway. There is a huge battle for hearts and minds on this issue. The amount of lobbying that goes and misinformation that goes with it is just, almost suffocating. But from where I sit, as you increase more intermittent energy into the energy mix, the costs of augmenting that intermittent generation into a reliable 24/7 supply become higher and higher and higher. And that's sort of where Australia is today. But looking forward, if we want to reduce the amount of coal in our energy mix and reducing emissions, then we're going to need more gas. And that's exactly what the UK did. It's exactly what the US did. And it's exactly what we're going to have to do. And so this shortage of domestic gas we're experiencing on the East Coast is here to stay. And so this is one of the key investment thematics that we're exposed to. Governments, specifically Victoria, are being dragged kicking and screaming into the reality of having to support not necessarily the growth, but just the replacement of their gas production, which has been underpinned by the Gippsland Basin for the last 30 years, but it is about to run out. And so though the gas prices are rising and the returns for investment in those projects are looking very positive indeed. But it's not just gas. It's what you really want, and this is where the fantastic margins are, is in that conversion of gas to electricity. So you need about 10 gigajoules of gas to produce 1 megawatt hour of electricity. That 10 gigajoules of gas will cost you about $120 all up. And during peak time, so that's in the evenings, you can sell that $120 worth of gas for $200 worth of electricity, and that'll give you a gross margin of about 30% historically. A lot of that gross margin you give back in maintenance costs and other costs, so hasn't been a fantastic business. But Australia now has the most volatile power prices in the world because of our diminishing amount of dispatchable energy and increasing amount of intermittent energy. And so we're having more and more events like this one where regularly, where there's a shortage in the evening peak, and this makes the headlines in New South Wales, Queensland and Victoria with increasing frequency. Power prices can spike as high as $16,000 per megawatt hour, and I think they've just increased the cap to $20,000 per megawatt hour. When that happens in a very small space of time, your reasonably pedestrian 30% gross margins go to 99% very, very quickly, albeit for a small space of time. But this is a structural change in our energy market, and those peakers are now becoming very, very, very valuable. Even more so if you've got your own supply of gas and it only costs you $5 on a cost basis rather than having to buy it in the market because there is a shortage. Pivoting now from a domestic thematic more to an international one, and this chart is very important for people who have been enjoying their commodities exposure via the index or via the major miners. The days of China using the property market to stimulate their economy are over, and this is why. They've got roughly 60 million spare apartments in China at the moment. The Chinese population declined by about 100 million people over the last year and a half. The last thing they want to do is build more properties because it's going to create more problems than it solves. So traditionally, that property stimulus, which has been a very boon for our iron ore sector, that is gone. Looking forward, the Chinese government is going to pivot towards domestic consumption. So by that I mean electric vehicles, a bit of infrastructure, consumer electronics, appliance replacement, energy efficiency. All these sectors are where that stimulus money is going to. So that means more copper, more aluminium, more rare earths, some of these boutique metals like sort of antimony and tungsten, things like that is where the future is for the commodities exposure for the next 5-10 years, probably the foreseeable future. Just to highlight some of the growth that's happened here. Clean energy contribution to GDP is has climbed materially over the last couple of years. I think up about 2%. But I might hand over to you and to provide a little bit more colour on that.
Sure, Sam. Yeah, I think as the chart highlights, it's grown around 50% over the past 2 years. But when you look at that starting point now, clean energy is just over 10% of China's GDP growth, and that's only going to continue moving into the future. I think everyone gets very focused on sort of clean energy transition, etc., but really it's very metals intensive. I mean, as you can see here, sort of like that electricity transmission storage is like a huge growing bucket, and that's copper. In particular, you're seeing that aluminium growth come through, rare earths. And what this means is you're seeing that slowdown in iron ore demand. And while there's sort of a lot of gloom and doom over where Chinese steel production is going to go, we think it doesn't fall off a cliff, but you don't see the rampant growth you've seen over the past 20 years. And I think these two charts here highlight why we think that bauxite is going to be sort of like the next iron ore. Traditionally, if you look at that 2015, China was able to supply all its domestic needs for bauxite consumption, about 70%. And then as the economy began to grow and they needed more aluminium, so traditionally it's 4 tons of bauxite gives you 2 tons of alumina, and then you go to 1 ton of aluminium. Around the same time, they were forced to look abroad, and that's where you see the growth in this sort of like medium grey area of Guinea production coming through, rising to about sort of 120 million tons. We saw a similar thing in iron ore, where China's domestic production is around 200 to 220 million tons, give or take, over time. And as that property boom came through and they needed more iron ore to feed the steel demands, that's where you saw the growth of the sectors in Australia and Brazil coming through. We're seeing a similar thing now in bauxite, where that Guinean production, those large open cut mines have largely been exhausted, and they're having to struggle to tie in new supply coming in. The infrastructure is really strained for bulk commodities. They're having to sit there and try and negotiate new rail infrastructure, new port, new mines, and that's something which doesn't happen overnight. It's not like a mine, like a lithium, where you can turn it on in the case of a few months. These are year-long decisions to come to the market, and we're seeing that ironically in Guinea as well with Simandou, where that project's been talked about for 10, 15 years, and only now has construction really begun to ramp up, and still we're years away from meaningful first ore. What this means then is you sort of have the breakdown of the Chinese economy in the chart on the left. So for the past 20, 25 years, demand drivers, as you can see, construction was everything. So that steel demand outpaced aluminium, which was primarily used for some of the transmission infrastructure or the finishing of apartments. As we've seen that demand for new construction wane, and there's no government impetus to really push that any further, you've begun to see that reverse. So now you can see, when you look at China's 14th five-year growth plan, they're very focused on the auto and electrical side of things, which comes back to that sort of clean energy, clean transition bucket. And you're seeing those roles reverse, where aluminium now is outpacing demand for steel for those sectors, and that's something that's not going to change. When you sit there and think about how you connect like 5G networks, these batteries, solar panels, wind farms, all this sort of thing, aluminium is going to be front and center. So for conductivity, it's around 60% of the conductivity of copper, but only 30% of the density. So ideally suited to long transmission lines. And this has been borne out by the pricing chart on the right, where you can see sort of volatility of iron ore over the past few years. And in reality, what sort of happened is when you average it out, it's been pretty flat price-wise, around that $100 a ton. And that's pretty close to the 90th percentile on the cost curve, where you're going to find some support. In the meantime, you see bauxite slowly creeping up as all of these issues in Guinea, which is the supply powerhouse, where there's been supply disruptions, government bans on exports, or just infrastructure blockages because you can't get the product out of the country fast enough. And that price has just kept creeping up and up and up. And I think this is where we exploit it as a fund, because traditionally, if you talk to the market, they weren't focused on bauxite. Traditionally, it was sort of vertically integrated. So you think about sort of your South 32s, your Alcoas, which are household names, I guess, in Australia, post-alumina acquisition, and bauxite was just an input. Everyone was very focused on the alumina refineries and then the aluminium smelters. No one cared about bauxite. What we're seeing now is that supply is beginning to diminish. That price has begun to creep up. And in reality, as you can sort of see here on the previous slide, Australian production, while it's not going to rival the Ghanaian side, what you're actually going to see is, as that Ghanaian production needs to grow, and structurally that's going to lead to higher price increases coming through. And that's only going to be good for the Australian producers.
Yeah, so this is one that's near and dear to the hearts of the Shore network. Shore's network, I'm sure. Yeah, it looks like Heinz is going to be correct on this one. We've I suppose just added to our or added back some profits we took earlier just a couple of weeks ago on those lows there after they announced an early restart to production. But what we're quite excited about and what the market I think is missing, because this shouldn't be trading on 2 times EBITDA and change, is the fact that Metro has a quarterly lagged mechanism in its pricing realisation. So this big tick up in prices here, they didn't enjoy that or didn't experience that in December, but they're going to in the June quarter starting now. So that's why those forward multiples look quite low, quite high conviction that that's where the price is. They've their production history is reasonably good. I mean, all the growth that for 2025 guidance was put in place in 2024. So the ramp up this year should be much quicker. And I think we're only going to need to have one glimpse at quarterly at the cash generation for a quarter, and this thing should start to rate materially. Which from 350 mil market cap now, I think the bottom end of the ASX 300 is sitting at around about that 500 to 600 mil market cap level. I think Metro does get to that level. Then it gets sucked up by the index buying, and this thing should be trading on circa 5 times EBITDA, just like the rest of the sector. So there's one area that we're looking at. I might skip through the next couple of slides and get to the next biggest, the biggest single commodity exposure at the moment, and that is gold. It has been working very, very well. Gold has detached from all the previous correlating indicators. It used to correlate reasonably well with real rates in the US, but since 2022, gold has really taken off while real rates have remained pretty much flat. Directionally, there still is a loose relationship there, but by and large, gold is running its own race now. And I think it's because charts like this one have become have moved more to the forefront of investors' minds, and that's the US deficit as a percent of GDP. So the US government themselves said, like their Treasury Secretary last year, and some other of the bureaucrats conceded that the US fiscal situation was unsustainable. So for the owner, I suppose, of the risk-free rate, which is a US government bond, to acknowledge that you have an unsustainable fiscal situation is quite unprecedented. So what I think the gold price is starting to factor in is a scenario where the US runs out of buyers of its government debt, and the Fed has to step in and start buying that debt itself, which is a return to quantitative easing and basically printing money and the debasement of the US dollar. And until that situation changes, I don't think gold is going to pull back materially. So looking where we are in 2025, the fiscal deficits are much worse than they were in 2024, and they're tracking more or less in line of where they were in the post-COVID era. Recent data from the US in terms of consumer sentiment and inflation outlook is probably quite bearish. The consumers there are starting to pull their heads in a bit. Interestingly, last night I just saw a chart which showed US homes for sale or on the market had hit 500,000. The peak in 2020, or the previous peak in 2027, just before the financial crisis, was 570,000. So we're getting close to that sort of level. So the US economically appears to be in a little bit of strife. That means that there's probably going to be more rate cuts than currently expected, and that is supportive of the gold price. Much longer term, if the basis of the risk-free rate, being the US government bond, loses that status, charts like this one start to become a bit more relevant. So this is gold as a percentage of FX reserves, and central banks, China, Japan, plenty of them, plenty throughout Eastern Europe, have pivoted towards gold rather and away from US Treasuries, and as a result, gold as a percentage of FX reserves is starting to tick up. Now, could this return anywhere near the levels it was when the gold standard was abandoned? And it's a bit of an open question, and it is a bit of an arm wavy type answer. But reading around a bit of the history here, it's fascinating to see how petrified the US government was of what would happen to the value of its currency and its status as the world's reserve currency as in anticipation of abandoning the gold standard. And they were so concerned about it. There is a line of argument or a bit of a conspiracy theory that they took active preventative measures to ensure that their currency was supported. So, and to do that, they needed to find a big buyer, like a really big buyer of US currency, and by that I mean US government debt. But no such buyer existed back in the early 70s. And so the suggestion is that they created a buyer. So they perhaps not encouraged, but maybe facilitated or certainly didn't move to prevent that the Yom Kippur War. In response to that, I think it's suggested that they encouraged Saudi, like in a response maybe, to restrict oil exports, which sounds like an outlandish claim until you realise or find out that not even 12 months after the invasion of Israel back in 1973, the US did a deal with Saudi Arabia to, one, only trade oil in US dollar terms, and two, to invest 70% of its newfound wealth, which was substantial as oil prices went through the roof, to invest that newfound wealth in government treasuries. And that's exactly what happened. And then a year after that, the rest of OPEC follows suit, and then the rest is history. They're actually so successful in the level of support for government bonds and the US dollar and the US dollar overall that they had to go back the other way in the mid 80s via the Plaza Accord, which they signed with the Japanese government and a few others to actually depreciate the US dollar because it was starting to weigh on their economy. But so this is an example of just how stressed or what can happen when faith in that our risk-free rate or our global reserve currency starts to fracture. And in that context, you can start to see, well, unless this deficit does improve, gold is probably going to continue to be an increasing proportion of FX reserves and at ever higher prices. So if that's the mile high type view, this is from the opposite end of the spectrum, very bottom up and literally microscopic type view in a sector which has been running as hard as the gold price for as long as it has. Where do you find value? And I think one area where there is a bit of value that we've identified is in a sort of a subsector of the gold market called refractory gold. So if you're not familiar with this term, most gold projects or listed gold projects today are free milling. So by free milling, I mean that gold, which is often associated with pyrite, is exposed at the grain boundary. So that means the cyanide, which is used to dissolve the gold, can get at the gold grain, dissolve it into solution, then it gets precipitated out on steel wool and melted down in a furnace. Refractory gold is deposits where the gold grain itself is locked up inside the sulfide mineral. APY is, in this case, stands for arsenopyrite. And these projects have had a very checkered history in Australia, but globally, there's no problem processing this. The technology exists. It only costs an extra $20, $25 a tonne to process this refractory ore, and you still get a recovery of 90%, which is pretty run of the mill. But once upon a time when the gold price was lower, that extra $25 a tonne might have been quite meaningful. Now it's less than 0.1 of a gram that you're giving up to get at that refractory deposit. So some examples of refractory projects which have done very well recently, Emerald Resources, run by Morgan Hart, their project in Cambodia called Okvau, that is a partially refractory deposit. Their recoveries are about 88%, produce a lot of free cash, no problems at all. De Grey, one of the great success stories of the last decade, that is a refractory deposit. Northern Star didn't care, they lobbed a bid for it anyway. But what we're interested in is this one in turquoise here, Rox Resources. Those guys have got the UME project in Western Australia. Once upon a time, it had a resource of 3 million ounces. That's been conservatively cut back, but I think it will grow out to that scale with more drilling. That is a partially refractory project, but it's been passed over because, people just don't like it. But as the value of gold goes up and up and up, the dollar amount of additional processing cost becomes less and less material. That project has gone from having a 3-year payback 2 years ago to a payback period of roughly 12 months today, and falling as the gold price goes up. So in aggregate, that's what we like. We like gas, we like gold, we like our bauxite. They're the things we're excited about over the next 12 months. So with there, I might pause for a little bit and see if we've got any questions. Sure.
If Trump reduces the sanctions against Russia,
Mhm.
and Russia's able to sell its commodities on the international market again, what's going to happen to the prices?
I think a lot of those commodities actually make their way into China. So with these sanctions get thrown up, you end up with like a sticker shock period and prices spike. But over the subsequent 12 months, like global trade is very, very good at reorganizing itself to, get around those sanctions. So, Russia is exporting the same amount of oil as it always has done. Yeah, probably more. The nickel, aluminium is largely flowing into China.
Yeah, aluminium is probably the big one the Western world would like some relief on, but ultimately Russia's getting a decent price, not at a discount compared to, say, oil, selling it to China. There's probably very little incentive to direct that flow to the Western world where it's at risk of sanctions again. I think oil is probably the big one, but ultimately that's still flowing at the moment.
But what about gold? When
Well, gold, I don't think the Russians would generally be hanging on to their gold, but certainly some of the angst in the gold market at the moment is being caused by the threat of tariffs on gold, importing it into the US. And that's sort of caused a bit of a rush for physical gold in the US because people trading gold futures contracts are demanding settlement in physical gold. And the US doesn't have it. And so they're importing it from London and they're importing it from Switzerland. And that's causing a shortage of physical gold in those countries. So to get your physical gold in London, it used to be a 2 to 3 day delay, but that's blown out to 3 or 4 weeks now. Same things happening in South Korea, same things happening in India. And I think same things also happening in China. So, there is some concerns around the fact that the physical gold market is actually much smaller than the paper market. And then there have been some big losses suffered by bullion banks who have been called on for gold delivery and haven't had it. Now, this hasn't turned into a worldwide systemic problem yet. I don't know if it will, but again, I think this is a bit of volatility that sits on the rising tide of central banks adding more and more gold to their reserves as an alternative to treasuries. I think that's the long-term story.
I think on Russia, the big positive, if you can term it that way, would be on the energy side. Because you sit there and look at straight away, all those gas pipelines back to Europe would reopen. Nord Stream 2 would get up and running. So that will bring down the cost of energy and would hopefully help restir some of that industrial shortage that's taken place. And then on uranium, probably see some more flows coming into Western Europe again and probably to the US on the raw and the enriched side as well. At the moment, Kazatomprom, who are Kazakhstan's national uranium producer, almost everything now is flowing to Russia and China. About 45% have previously been down at 15% of volumes as little as like 5 years ago.
you actually see that opening up again, do you see that Russia is going to become part of the
IBU. I'm not quite so sure. I don't know if the US would be keen on Europe importing more gas from Russia again.
I don't think Europe will be very good.
People say it, but ultimately Germany would fight off the hand to get that cheap gas because that's what powered that industrial growth. I mean, you sit there and look at where Nord Stream 2 and those gas pipelines go to, it's all very
The new president wasn't very pro-Russian, was he?
No. We wait and see. If it does transpire, it doesn't. We're very focused on domestic gas. We're sort of largely isolated from the international market here in Australia, but we've got our own problems because our domestic gas supplies are running out, which are located in New South Wales. Well, not so much New South Wales, but mainly Victoria. Queensland's a little bit different, but you've only got one pipeline between the two. But yeah, it's not. We're not exposed to European gas prices, so it's not really a worry for us.
How are you playing gas exposure? Sam?
Mainly through, we've got a few. So Altitude Energy would be the biggest position. We've got a bit of exposure through EMP, which is a tiny little company, which they have a block which Shell drilled back in '89, and they struck gas, a lot of gas. It's like 180 metres of gas. But in '89, the gas price was like $3 a gigajoule. Melbourne and southeastern Australia was well supplied, so Shell didn't even bother flowing it, and they moved on, and it's sat there ever since. But they certainly need that now. They would be probably the main ones, and there's QPM Energy up in Queensland would be another one. They've got the gas peakers up there, but that's probably a 2026 story in terms of earnings.
Obviously, you guys are quite bullish gas. What do you think of the coalition's new plan to mandate reservations domestically? What does that do to the price? I know WA do that already, I think.
Yeah, I mean, short term, it won't make any difference, I don't think. It should encourage. It still is. I mean, the supply response is more than anything else is encouraged by price, and that price is going to remain high for at least 5 years because that supply response will take time. And also, like the domestic reservation policy is a bit of a furphy because any of the new projects around Victoria and even Gina's projects up in Queensland, the Atlas project that she is in JV with POSCO is, I mean, all that gas was promised to the domestic market, so it's nothing new.
No.
I don't think it'll make any difference.
Sorry, a couple of questions. I noticed when you wrapped up, then you didn't say copper that you were bullish about, or like where do you stand on copper? And also, uranium's massively bombed out right now, and I was just wondering what your thoughts are. I had one other question on Doug, as a shareholder, as an investor in your fund.
Yep.
Doug's obviously been a big underperformer. They came in the other day. They did a presentation here. I wasn't, I don't know. I couldn't work it out. So I was just interested in those.
Sure. Sure. I mean, do you want to touch the copper price, Stuart?
Yeah, I mean, copper at the moment is sort of, choose my words carefully, but a bit of an artificial balance because of the prospect of tariffs coming in. So you've seen the divergence between.
That's why the stocks up.
Exactly. That's why they haven't really responded, because ultimately when we sit there and look, there was a bit of an inventory build up of China Lunar New Year, but you've not really seen that destocking come through, which you'd associate with demand and tightness in the market. So while supply has been a bit constrained, you're not seeing that demand really rip for obvious reasons. I think if suddenly that China stimulus really pushes forward and sort of the Western economies really kick on, then you'd begin to see the actions match the pricing increase that we've seen on the physical, but we think it's probably a little bit of a short-term bounce, and it's probably something where we have a bit of copper, but probably not to take any profits ahead of some of those tariffs coming in.
Uranium, I think, suffered a little bit by some loose inventories that have, come out of the financial movement of the financial sector out of the uranium price, which is was sort of already beginning, but then it accelerated after that DeepSeek announcement in January. Where all of a sudden the power demand from AI seemed to be a lot less than what people were expecting. Because uranium is such a tiny market, it's only 67,000 tonnes a year, it really does get pushed around by the financial flows in and out. So I think and a little bit of spare inventory goes quite a long way, which is why spot's trading at a big discount to the term price. Well, that's what I think at the moment. So slowly but surely that spot volumes will get soaked up. It's only a very small part of the market. I think that some of the initial knee-jerk reaction to the DeepSeek news is starting to reverse. People realising that no, we still actually need a huge amount of electricity to realise our AI ambitions. I think the head of NVIDIA was quoted a couple of days ago saying that their new reasoning chip or whatever requires about 100 times more compute than traditional AI. So that the exuberance for, or the enthusiasm for a big growth in power demand, I think, is returning, and that'll be supportive of the uranium thematic.
Okay.
And Doug?
Yeah.
So I caught up with Dan, which is the Matt's son, at the conference 2 weeks ago, and it was interesting. It was good to get to sit down with him and just get some more colour around where does this conviction for forward orders comes from. And it comes from his view of the correspondence between their technical sort of experts or leads and their clients, and the constant requests for more work and more data. So that's one part of it, and the other part of it is the vote of confidence. I think indicative from a recent hire, which they haven't, for some reason they haven't announced, but they managed to poach like the head geo out of Woodside to go and work for Doug and help market their seismic processing technology around the world. So I mean, I don't know what you get paid as the head geo of Woodside, but it'd be a decent wedge. And I don't think Doug would have been able to match that in this via base salary. So it would have been through probably options and upside. So I think the technology is sound. It's just it's just going to be dealing with these lumpiness of orders and the market's reaction to that. But probably as much conviction as I had on that, it sounds like the inquiries for Nomad, that remote remote compute technology that they've got, that's growing. So when I spoke to Matt, probably November last year, there was a strong lead out of India, a strong lead out of the US. Those leads are both there. There's some argy-bargy on price and other bits and pieces going on with the Indian entity, but they've been joined by solid inquiries out of Japan, out of Malaysia, and I think maybe one more out of Vietnam from memory. So I think the technology is sound. The revenue growth will return. It's probably, I mean, even on consensus numbers now, it's on maybe 12 or 13 times PE. So it is reasonably cheap for a stock which I think has a fantastic growth outlook ahead of it.
Any news on them finding a new CFO?
Yeah, well progressed. And Dan says it's definitely not him. That's the son. So he says they're down to 2. So it is legit that they're trying to get a decent CFO in the chair, but due to a few false starts there, they're very anxious to make sure this one hangs around for a while.
It's who are the major explorers, I guess, in Australia now?
By dollar amount, it's probably still the majors, Woodside and Santos.
Yeah, Woodside, Santos would still be the main ones. I mean, and probably Origin as well. And it's a bit of a false title to put on them because, for example, Origin and Santos are having to constantly try and find new gas to maintain production at their LNG facilities. Like those costs keep going up, that capex keeps going up because there's concerns that they haven't got enough to fulfill those 20-year terms. Woodside, obviously, post the BHP acquisition is in that strait, so they're drilling around there. And then obviously there's various work going on to sort of try and backfill Northwest Shelf, and then Santos have got Barossa come in to Darwin LNG. But in terms of new projects coming through, I mean, the major one that's probably sat there is Santos with Narrabri. But to Sam's earlier point, that's sort of like stuck in red tape, and ultimately that should come and feed the domestic market, but nothing's happened there for years. So it's hard to really see with that new supplies coming on, or when you speak to Woodside and Santos, they're not particularly constructive about putting dollars to work from a return perspective in Australia versus maybe looking offshore.
I've had a hilarious, well, it's not really hilarious. It's you have to laugh if you didn't cry. Anecdote from it was 3D Energy I was chatting to last week. So these guys have got a joint venture with Conoco down in offshore Victoria, and they were saying that they're just in the process now where they're applying for their exploration permit to go and drill a couple of wells offshore. And the MD there's been in the industry for 40 years. Said 10 years ago, if you wanted a drill permit offshore, the application for that was about 100 pages long to go through exactly how you're going to go through the process and plug and abandon if the well was a duster. That same application today is a 30,000 page document, including a heritage survey 40 kilometres off the coast in 50 metres of water, which they had to do as part of that application process. So these are some of the hurdles that the Victorian government has thrown up in front of the industry, which implicitly, rather than implicitly banning it, like this is why it's been so slow for a supply response. But these wells run out, and if you don't have a replacement there, well, prices are going to soar. And I think I don't know if you're familiar with what happened with in New Zealand last year, but going back to 2018, Jacinta Ardern banned oil and gas exploration in New Zealand. 6 years after that, their gas production had fallen to about 40% below the peak, below the prior peak, which didn't matter whilst it was rained, because they get 60% of their power from hydro. But then they had a dry winter, and the hydro dams started to get very low, so power was restricted, and they ran out of gas. And so their gas price shot from $10 a gigajoule up to 35. They had to shut down a large part of their manufacturing industry. The suppliers to that industry also got shut down, and it was an absolute disaster for them. For real, sort of a hand-wringing moment for about a month and a half until it rained, and then the dams filled back up again. But the same thing's happening this year. Those dam levels are starting to decline again. There's no gas. They're madly trying to permit and construct LNG import facilities so that they have a bit of a buffer there for emergencies. But their cost of power in New Zealand is going to go through the roof, which is ridiculous, because most places with a lot of hydro, their power is dirt cheap, but you need to make sure you don't run out of it.
So where does Snowy 2 fit into the equation?
I don't know if it's going to make that much of a difference. I mean, it doesn't produce any net power. It's just a big battery. They've got to pump the water up and down the hill. And that's probably not due until early 2030s would be best.
Yeah, early 2030s. I mean, it keeps laid. I think the way we probably think about Snowy is less what does it provide to the market. It's more the delay for AGL, Origin, Energy Australia, and Inter, because they're reluctant to take any meaningful investment decision on building out big generation capacity in the manner of, say, the coal power station, which have underwritten their portfolio for decades, because they said again, well, if the government's going to keep underwriting this huge battery power source, we'll hold off and just keep building peaking capacity here or there and wait to see when that gets built, how it gets utilised. And if the government, we spoke to Clough who are building it, and their sort of plans to keep building further legs of it. So it's less about what does it do to the price, more does it disincentivize new generation capacity coming on. And ultimately, when we sit there and think about energy prices, you want to have that stability in the grid and that certainty of supply, and that's where it's a bit uncertain at the moment.
Just to put some context around Snowy and what it means for the NEM. So one of those, there's many big problems within the NEM that need to be solved, but probably the biggest one is the seasonal demand for electricity from Victoria because it gets cold. That seasonal demand is what you're looking at right here. So baseline industrial demand for gas in Victoria sits around about this level. Then each winter, people turn their heaters on, and that's where the demand spikes. Snowy Hydro 2, I think, is big enough to store power for about just over 7 days for all of New South Wales. So you're looking at maybe 1 week of this, and then you've got a massive power demand to fill the dams at the top of the scheme all the way back up again. So it's a partial solution at best. It's very, very difficult to replace that amount of energy in a way that's cost effective. Very, very hard. And that's you can deal with sort of intermittency, day to day in summertime. We get plenty of solar here. That's not so much of a problem, but that seasonality is a massive problem, and that's what a lot of the debate overlooks or misses out on.
I was just going to ask, in terms of your fund, last time we met you, can't remember how much AUM you had, but it wasn't a huge amount. But over the last 6 months or so, because personally I feel like the commodities have started to turn, money coming out of tech, yada yada. Are you starting to see institutional demand, big family private offices start to allocate to commodities?
Yeah, so inflows have definitely picked up. So I'm not sure where we were last time, but FUM's doubled in the last 12 months. So we're sitting around $50 million now, and growing at an increasing rate. I think there was we had bucket loads of interest at sort of 30 mil, and people didn't want to be too big a part of the fund, but those concerns have been have gone by the by now. So that's a non-issue. Yes. In short, the answer is that the flows are starting to pick up. Whether that's a function of an improvement in I suppose outlook for the sector, or whether it's just performance, because we've been reasonably steady. I'm not quite sure, but certainly we're growing reasonably steadily now and at a slightly increasing rate, if anything.
All good?
No worries.
If that's all good.
Yeah, all right. Oh,
Beauty. Oh, no, but I just thank you everyone for coming in today. Just to give a bit of context around the thematic and the we do these events on is that we're always kind of hunting around on behalf of the team. Saw a photo of us up there before, probably know. But in terms of thematic, we're big on trying to find areas that we believe the downside's pretty measured or limited, but there's considerable upside. Some of the people who came to the events, I think it was late 23, we're heavily focusing on gold. I think early last year around mid caps, and about 6 months ago, if you're on any of our email distribution list, we were starting to push a bit into China. This is another thematic that we think really ticks the bill. And obviously the best way to play that is with the Perennial team. We've got a bit of money with them and there's more coming that way. But this is a good example of some of the work, I think, with regards to the team and the areas we focus on. So we encourage people to share these ideas, give invitations to people that might be interested with them. We want to share these kind of ideas and thoughts. You'd be surprised how many people don't get access to that kind of work. But also massive thanks to the guys from Perennial and also their outlook and insight into the space. Obviously a pretty complex area, so a good set of hands is very hard to come by. And we're more than happy to be teaming up with Perennial to kind of go on that journey with them. So